Revolutionizing peer-to-peer lending. Why is it that there's hundreds of lending companies, but not a single one's willing to give a loan to someone who lacks the proper credit history? My name is Andrew, and my teammate's name is Hoa, and over the past couple of months, we have been researching, developing, and trying to brainstorm solutions to this problem. This is a serious issue because it prohibits millions of people from getting loans to enhance their life. So without further ado, let us dive into the insights and observations that we found while researching this. Throughout this presentation, the main points that we want to discuss are the backgrounds of peer-to-peer lending, our 5 biggest competitors and their SWOT analysis, along with the pain points that they originally attempted to address, who we are, and our possible solutions to the lack of loans that are available for those with an insufficient credit history. So next, let's jump into the background of peer-to-peer lending.
So, what is peer-to-peer lending? Peer-to-peer lending enable individual to borrow and lend money directly through online platform, bypassing traditional banks. It also connects borrower seeking funds with investor looking to earn returns, offering a competitive rate and streamlined loan process. There are many different peer-to-peer lending platforms on the market right now, but here are our top five competitor. Zoba was founded in 2005, Lending Club in 2007, SoFi in 2011, Avance in 2012, and Upstart in 2014.
Zippo was founded in 2005, so it technically pioneered the peer-to-peer lending market. They offer diverse products and they have continued to adapt with technology. They've been around for almost 20 years now, so they must be doing something right. With every lending company, you're going to have weaknesses and threats. Zippo has limited geographical presence, they have competitive pressure from traditional banks, and they're relying on investors for their lending capital. They also have threats of economic uncertainty or volatility, regulatory changes that adapt with the market, and new product offerings, market saturation from new lending companies. But they also continue to have opportunities to expand into new markets, collaborate with different partners and corporations. So, with that being said, let's jump into what Zippo's original pain points that they addressed were when they founded in 2005. When Zippo came to the market in 2005, they wanted to combat the high interest rates that traditional banks were offering on their loans. They sought to have a large customer acquisition when they first launched in 2005, and they wanted to make a more efficient process for loan applications and lenders. Traditionally, it would take a very long time for loans to get approved, and Zippo wanted to streamline this process. But previously, there was also a lack of transparency with loan rates, terms, repayments, refinancing options, etc. So Zippo wanted to address this. They wanted to be more upfront about their rates, their refinancing options, and what they could do to help the borrowers. Lastly, they tried to make loans more attainable for borrowers who had a short credit history or an unacceptable one. So next, let's talk about Lending Club, and this is one of the top lenders in the market today.
Moving on to Lending Club's SWOT analysis. Lending Club is a leading marketplace lender which supported by advanced technology and offer a diverse loan product. However, Lending Club still have major weaknesses such as regulatory complexity, credit and insecure loans, intensifying competition, and economic sensitivity. However, there's many opportunity for Lending Club to grow, such as expansion into new market, form a partnership with big financial institution, leveraging a technology to offer new products, and harnessing data for product innovation. Lending Club is still facing multiple threats, such as economy turns down, regulatory change, intensifying competition, and potential disruption from emerging technology. In regard to Lending Club pain point, they was founded to offer a low interest rate to borrower as compared to traditional banks and credit card. They also attempt to provide loans to people who does not have a credit history or could not get a traditional loan. They streamline the application process, which make the loan acceptance so much quicker. They also attempt to help investor invest beyond stock and bond to obtain higher return. And last but not least, they aim to increase transparency among borrower and investor, including borrower information and upfront rates.
SoFi was founded in 2011, and they currently possess a very strong brand reputation and offering an array of products. SoFi has continued to expand into new markets and continues releasing new products. They've also previously partnered with companies and continue their growth opportunities, like creating SoFi Stadium out in California, which undoubtedly boosts their brand recognition and reputation. On the other hand, they're not immune to market fluctuations, competition from other banks and companies, evolving regulatory standards, and unforeseen economic downturns. So with that being said, let's jump into SoFi's pain points that they originally addressed when they were first founded in 2011. In 2011, what were the pain points that SoFi originally wanted to address? The The first thing they sought to do was offer lower refinancing rates and more options to refinance for student loans. And I'm sure that we all know the rates for student loans are through the roof. They also wanted to create a more personal approach for younger borrowers. Borrowing money can be a very stressful experience, so they wanted to make this as stressless as possible. SoFi also aimed to make an established network among its members. They also offer career developmental services and financial education. So, with that being said, let's jump into our fourth competitor, which is Avant. Avant was founded in 2012, so it hasn't been on the market for as long as some of our other competitors. They have a very strong leadership in computer services that contains a talented and skilled workforce. They offer a very competitive product mix that boosts their brand recognition, and Avant struggles with market share due to the fierce competition of other lending companies, and their business model is also easy to replicate. Due to having such skilled workers, this is one of their main threats, along with market saturation of other lending companies, economic volatility, and legal issues. Avant has continued to evolve and adapt. They will have expansion opportunities as the U.S. economy continues to grow in the future, and they will be able to leverage their technological advances for productivity gains. So let's move on to Avant's original pain points that they intended to address when they first founded in 2012. When Avant was founded in 2012, they intended to address a handful of pain points. They attempted to make loans more accessible to middle income individuals. Traditionally, and still some today, banks and other lenders would strive for prime borrowers that have a near perfect credit history. And as we know, if you only strive for these borrowers, you are possibly missing some of the other market. So Avant also sought to make the lengthy loan process more simplified that would provide decisions within minutes and funds as soon as the next day. They also wanted to be more upfront with their lending terms and eliminating any hidden fees. Avant also tried to address the inadequate customer support of other lending companies. They sought to guide borrowers through the stressful borrowing process. Avant also attempted to make more repayment options available, along with the ability to adjust payment dates and other refinancing options. So, next, let's move into our last competitor. Upstart is our most recent competitor, who was founded in 2014. They offer a variety of loan options and they have been successful partnering with corporations and banks within the finance world. Most recently, though, they partnered with Liberty Savings Bank to offer more personal loans. They've also been leveraging technology for risk assessment for their lenders. Upstart also has potential for international market expansion, new partnerships in the future, and offering new products. Like all other lending companies, though, they face regulatory constraints, economic uncertainty, dependence on technology, cybersecurity risk, and intense competition from other traditional banks and lenders in the finance world. Being relatively new, though, Upstart still faces relatively low brand recognition problems. So, with that being said, let's jump into the original pain points that Upstart originally attempted to address. When Upstart was founded, they tried to address the harsh FICO credit scoring by using alternate ways of credit scoring. Just like every other lending company, they attempted to address risk more accurately to combat high interest rates. Upstart also sought to streamline the application process to provide quick decisions within the same day and funding for borrowers as soon as next day. They also aim to make the lender experience more pleasant by reducing the risk for loan defaults and leveraging AI and technology. Lastly, they attempted to operate fairly within regulatory compliances and eliminate underlying bias. So, with that being said, let us move into the next slide and go over the similarities that all of our competitors share.
So, what similarity do our competitors share? They are excellent in utilize technology for efficient lending process and risk assessment. However, they still face regulatory uncertainty in fintech landscape. They have huge opportunity in market growth, offer change for expansion and product diversification. They're still facing many competition from traditional institution and fintech startup, threaten their profitability.
When you operate a peer to peer lending company, you pretty much abide by all the same guidelines that every other company does. So, what all does that entail? In the next slide, we'll talk about the common challenges that we all see. The first common challenge that every company faces is regulatory compliance standards. You must make sure that you have all the necessary operating licenses, protecting your investors from the risk to the best of your ability, upholding ethical borrower fairness, secure data and privacy, and honest financial reporting. Every company also wants to minimize their risk as a whole, which means trying to get loan defaults as close to zero as possible, having trustworthy lenders, and operating a transparent business to avoid lawsuits. Market competition is also intense with hundreds of lenders and other well-established banks that have been around for years. As technology continues to increase, security measures also need to increase exponentially. This is to prevent customers' data from being leaked. Already, I'm sure most of us have been involved in a data breach in one way or another. It will only get worse if security does not keep up with the technological advancements. So, next, let's jump into our company that we've founded.
So let me introduce to you FinFriend, our latest peer-to-peer lending technology. Our platform provides equal access to financial opportunity for individuals without credit history or those that are unable to secure traditional loan, while offering investor diversified opportunity for competitive return. For advanced technology, our platform features a user-friendly app utilizing AI algorithm and underwriting model for continuous monitoring and risk management. We also prioritize user data protection, mitigate fraud risk, and build trust through advanced security measures, addressing competitor challenge in compliance, risk management, and market competition and innovation.
The peer-to-peer lending market is massive. By 2030, the market cap of the total addressable market is expected to grow, surpassing $1 trillion. Also, the serviceable addressable market is projected to be around 800 billion, and the serviceable obtainable market is expected to be quite a bit lower, probably around 100 billion by 2030. But regardless, the potential upside for peer-to-peer lending is astronomical. So how can FinFriend fit in? FinFriend is focused on targeting underserved customers with insufficient credit or who will be rejected for a loan for similar reasons. So let's jump into the suitable loans for everyone and how we can get to this end goal. It has been a goal for a long time to eliminate the bias with loan applications. FinFriend is focused on everyone having an attainable opportunity for loan acceptance. We are interested in using alternative data scoring such as collecting utility payments, rental payments, educational background, learning about your personal life, and other similar forms of scoring. This will replace the traditional FICO scoring that rejects a lot of loan applicants. We would like for everyone to have financial opportunities that they desire. We can provide grace periods and adjustments for repayment schedules, and it's also a possibility to track users' unnecessary expenses that would be going towards the payments of the loan. So with that being said, let us move on to the next slide.
How we deal with money has been indeed improved by advancing technology, encouraging us to invest in our future better. That's why FinFriend is proud to utilize AI algorithm to enhance risk assessment and support, which is a smart solution for financial success. We have AI-driven risk assessment for a borrower, personalized assistant for optimal decision, and enhanced user experience via AI-driven intervention. So, how would utilize AI algorithm profit our investor and lenders? We utilize AI for automatic credit score, analyzing alternative data like employment history or rent payment for credit worthiness assessment to charge interest on loan. Secondly, we integrate machine learning with lending decision making to adjust interest rate based on borrower risk profile more accurately for secondary market trading. And we also use AI algorithm to analyze borrower behavior for early default sign, offer intervention like payment reminder, detect fraud identity and credit worthiness, and automate regulatory compliance for data security to improve user experience.
So meet Finley. Finley is FinFriend's 24/7 AI virtual assistant. Similar to Bank of America's Erica, Finley will operate in the same fashion. Finley will be available for around-the-clock support that can help customers learn the platform, generate summaries of their bills, access financial education tools, and make them overall more interested in the app and willing and wanting to use it. AI algorithms will be able to provide borrowers with suitable loans that match their needs, and the borrowing process will be streamlined with decision in minutes, and funds will be available the same day. Next, Finley will be able to monitor users' financial health. Finley will be able to track trends in customer spending, pay stubs, investments, and Finley will be able to help customers achieve their long-time financial goals. So after that, let's talk about our cutting-edge security that will be invested in the app. As we briefly mentioned before, as technology increases, security measures also need to significantly increase. AI and advancements in technology will be able to help stop fraud with pattern recognitions. For example, does a new account open and apply for an unusual loan? AI will be able to monitor account activities in real time and be able to detect suspicious changes in account activity or falsified information. AI will be able to also review and enforce operations that comply with up-to-date regulatory compliance standards. So with that being said, let's dive more into depth about these security measurements. Since technology is advancing, it's in everyone's best interest to encrypt the user's data. Also with dual encryption, only the sender and receiver will be able to see the contents of the message. Using biometric security such as fingerprints and facial recognition and multi-factor authentication, this will help secure the user's data. Many of us have probably gotten that email that says your Facebook password is trying to be reset. Well, we need to use these same precautions here. With blockchain technology, records cannot be imitated. There is increased transparency because everyone can see every transaction history. Because there's no central ledger, it's impossible for there to be a central point of failure. With AI, it will be the quickest to know if there's unusual behavior or traffic on the network, and it can prevent any breaches or cybersecurity risks. Technology breaches will also be able to be used in our favor because we can utilize vulnerability testing for firewalls and current anti-breach precautions. Going to these extents, we can ensure that everyone's data is protected no matter where it is stored. With AI, we will always be able to ensure that FinFriend is operating within the current regulatory standards.
In conclusion, based on our research of the market, accessible loans have been fueling economic growth and excitement, particularly in the global market in recent years. Based on our analysis of the market, we have identified the strength, weaknesses, opportunity, and threat of our competitor in the peer-to-peer lending space. By using this information, we have developed our own peer-to-peer lending app called FinFriend that addresses all the pain point of the market. Our platform offers expanded risk management opportunity powered by AI to provide a safe and reliable lending experience for all users. By leveraging our strength and opportunity, we believe that we have a competitive edge in the market. Thank you guys so much for considering our analysis, and we look forward to bringing this innovative solution to the peer to peer lending industry. Thank you for listening.